In this video, I want to consider how to use technical analysis to predict short-term stock movement. How to use technical analysis to predict short-term stock movements. First of all, we need to understand, what technical analysis is all about. Number one, understanding technical analysis. Technical analysis involves studying historical price and volume data to forecast future price movements. You rely much on them, price past price and volume data to see if you could predict the future movements of stocks. It is based on the idea that historical price movements tend to repeat themselves due to market psychology. The investor psychology that produce those those past movements, are still intact. They could likely repeat the same events again, or behave the same way in the same pattern again, which will also produce same effect on stock prices. So technical analysts use various tools. They use charts, they use patterns, to identify trends and potential reversals, in the markets. They use those past data to identify when the trend is going up and when the trend is about to reverse itself. Number two, key components of technical analysis. Key components of technical analysis. Number one here is price charts. Price charts. The foundation of technical analysis, price charts, shows historical price actions over time. Common type include line charts, bar charts, and candlestick charts. These are different kind of charts. Traders adopt to carry out their trades. Then you have volume. So volume represents the number of shares traded during a specific period. It's crucial for confirming trends. A price move accompanied by high volume is considered more significant than a move with low volume. So you take into consideration how high or small, how high or low the volume is, and the action it has on the price movement of stocks. Then you have trends. In this case, identifying trends up or down or sideways is essential. Is it up, is it down, or is it just going sideways? It's essential you understand. So trends are the direction in which a stock is moving, and technical analysis aims to capture the trend before it reverses or consolidates. So you look at an uptrend, you want to buy before it reverses to a downtrend, like that. And if it's in a downtrend, you may decide to short the stocks and still make money. Number three is common technical indicators for short-term predictions. Common technical indicators for short-term prediction. Number one is moving averages. So you have simple moving average and exponential moving average. Simple moving average as well as exponential moving average. These are commonly used to smooth out price data and identify the direction of trends. You equally have what is called a crossover. A crossover occurs when a short-term moving average crosses a long-term moving average, often signaling a potential change in trend direction. Example is a golden cross or a dead cross. Short-term traders may focus on the 5 or 10 days moving average to catch quicker trend changes. Another important indicator is the relative strength index. The relative strength index. So the RIS, as is short in the short form, is It's a momentum oscillator that measures the speeds and changes of price movement, typically ranging from 0 to 100. So the relative strength and index, above 70 is considered overbought, while an RSI below 30 is considered oversold. So short-term traders use these signals to identify potential reversals or corrections. The next item is moving averages, convergence, divergence. Moving average, convergence, divergence. So the MACD is a trend following momentum indicator that shows the relationship between two moving averages, usually, the 12-day EMA and then the 206 and the 26 days, EMA. So when the MACD crosses above the signal line, that's a 9-day EMA, it builds signals, and when it crosses below, it's a bearish signal. So MACD histogram and divergence between MACD and price actions can also provide insight into potential reversals. Personally, I don't do technical analysis. I'm not a stock trader. I am a long-term, buy and hold investor. All right. I don't use all these indicators. But if you are interested, fine. You could dig deep. You could dig deeper into how it influences price movements, and you could adopt them, in trading if you're interested in day trading. But I must warn you that I must add a note of warning here that over 90% of traders don't make money. Try. And I wonder why people are still going into stock trading. Over 90, that is the established statistics. Over 90%, they don't make money consistently. And yet, if you have a class on fundamental investing and you have a class on technical analysis, stock trading, many people are going to enroll in a class that has to do with stock trading. They're looking for fast money and they end up blowing their accounts as a result. Well, it's a matter of individual preference. One man's meat is another man's poison, as they say. Please subscribe to this channel and like this video. Number 5 is support and resistance level. Support and resistance level. Support is a price, it's a price level where a stock tends to find buying interest, preventing the price from falling further. When you come to a support level, usually it's at the bottom, the price cannot fall below its support level. It might keep on coming down, 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 down. At that stage, the price will the stock will kind of acquire or will experience, more buying than selling, and the stock will stop, the downward trend will stop and start moving up. So that particular bottom is called the support level. And you have the resistance. This is a level where selling pressure usually increases, preventing the price from rising further. Usually, when the price goes up, it will get to a point at the peak where it cannot go further, because at that point, people that bought at the trough, at the bottom, will want to take profits. So at that stage, you have more selling than buying, and the graph, the movement will now come back, start coming down again. This level helps identify potential entry and exit points. A breakout above resistance or a breakdown below support can signal a new short-term trend. The question is this: how do you know that the price will then go below, we go below the support level or go higher than the resistance level? That is it. Nobody can predict this movement accurately, and yet you have some people that they want some people are doing predictions that I don't really understand. I don't want to use names that are not really appropriate for this channel, but I begin to wonder, you know, it's okay. Everybody has his own preference, when it comes to investing. It's okay. So number six is volume. Volume analysis. Volume plays a crucial role in confirming trends. For instance, when a stock price moves on up with an increasing volume, it confirms the strength of the uptrend. When you have large volumes coming in and the price is going up, so that's a substantial uptrend. Conversely, if a price move happens with decreasing volume, it shows a weaker momentum and the possibility of a reversal. Usually, as the movement occurs, and you could detect a decrease in volume. That means that the trend is about to reverse itself. The volume that pushed it up is no longer there. The trend will I hope I'm not getting attracted to technical analysis. So the volume that pushed the price up is no longer there. The price will is about to drop. So that's it about technical analysis. Personally, I'm not really interested. It doesn't really sound melodious to my ears. I prefer fundamental analysis where you really deal with factors that really matter, not volume and price and charts. Some. Well, let's stop there. Thank you very much for watching.